Hello, welcome back to the second part of lesson 3.5. We're still talking about stocks and investments, and we're going to extend our learning a little bit here. Starting on page 333, we're going to learn a little bit more about the price to earnings ratio for a stock. It says the price to earnings ratio, commonly known as the PE ratio, is a key indicator of how reasonable the current price of a stock is. It compares the selling price of a stock to the annual amount of money the company has earned per share. If the PE ratio for a certain stock is 20, that means that the current selling price is 20 times as high as the earnings per share. This tells us that for every $20 you invest in the company, that company will earn $1. PE ratio can be a little tricky to interpret. On the one hand, a lower PE ratio indicates that a stock is priced reasonably, as you need to invest less for the company to make a certain amount of profit. But if investors believe in the growth potential of a company, they may be willing to pay a premium for the stock, which will result in a higher PE ratio. To help get some perspective on PE ratio, it's useful to do some calculations. First, a formal definition. So the PE ratio meaning we're comparing two values. One is the current market price divided by the annual earnings per share. For the Facebook stock table from earlier in the lesson, calculate the PE ratio using the current price and the earnings per share. Compare the PE ratio listed in the table. So we're going to calculate the PE ratio for the Facebook stock. And the Facebook stock's current price was $162.28. And we're going to divide by the annual earnings per share, which is right here, the annual earnings per share, 7.57. So 162.28 divided by 7.57, and we get 21.44. And the table that we were looking at, the PE ratio was 21.44, which was the same. Ours is rounded up to 4.4. So not every stock table you will encounter has quite the wealth of information that the ones at the beginning of this lesson. A more abbreviated table might have the PE ratio, but not earnings per share listed. So in which case you have to do some solving to find that. Down below, they show how you might have to solve for that. If you're given the PE ratio of, say, a company, this GoDaddy had a PE ratio of 166.56, and their current price was $74.95, then their earnings per share would be by taking the $74.95 and dividing by the PE ratio. And we would find out that the earnings per share was 0.45. Based on the result of solved example 1, which do you think was a better investment at that point in time, Facebook or GoDaddy? So the PE ratio of Facebook was 21.44 and GoDaddy was 166.56. And I would think that the Facebook was better. It was lower and their value really went up because it was lower, 21.44, and its value went up, although Facebook's been getting a lot of bad hype lately. So let's look at the table below. It says the table below summarizes some basic rules of thumb when it comes to interpreting the PE ratio for a stock. Remember that the best approach is to compare a stock's PE ratio to other companies in the same industry, as current market conditions can have a pretty profound effect on PE ratio. So not available means the company has no earnings. It's also standard for a company with negative earnings. Ooh, we don't want to do that. A 0 to 10 is the stock may be undervalued, making it a good buy. Alternatively, investors might feel like the earnings are likely to decline. The company may have shown short-term profit from selling assets that will hurt earnings in the long term. 10 to 17 is the PE ratios in this range are historically considered to represent stocks being sold at fair market value. 17 to 25 is where Facebook was. The stock may be overvalued, so shop carefully. So shop carefully. On the other hand, earnings may have increased since the last official earnings report was released. The company might be up and coming with earnings expected to increase dramatically at some point. And bigger than 25, which was this GoDaddy. The stock might be very overpriced at the moment, or the company may be expected to have a big jump in earnings coming up. So it says, we saw in solved example 1 that the PE ratio for GoDaddy was extremely ridiculously high. Come up with some theories as to why that might have been the case. GoDaddy, I think, was creating your own website. So maybe investors thought it would make a lot of money creating websites for millions of companies. Because GoDaddy sold website addresses, I believe, and like pre-made websites. Yep. Domains and websites, and web hosting. The next little bit of this part of the video is on page 335, and it talks about investing in bonds. So when an investor buys bonds, the investor is actually loaning money to the company or government entity that issues the bonds. In exchange for lending that money, the investor will receive a fixed return on his or her investment for a given period of time. The ending value of the bond is called the face value. This is typically $1,000, but can vary. Bonds also have a maturity date, which is the date that the face value is returned to the investor, as well as interest. In some cases, no interest is paid until the maturity date, at which time the full amount of interest is paid. Coupon bonds, on the other hand, pay an annual or semi-annual interest payment, known as a coupon. You can think of it this way. If someone offers to sell you a $20 bill for $15, that's a pretty darn good deal. But the catch is that you don't get the $20 until some predetermined time later down the road. That's what a bond is. It's actually pretty simple. But here's where it can get more interesting. Suppose that you got tired of waiting for the time when you get that $20 bill and you sell the bond to your neighbor for $18. You've made $3 on your investment and you're done. Your neighbor now waits until the maturity date, cashes in the bond, and makes the other $2 of the original $5 in profit. This is how bonds are bought and sold on the open market. Of course, your neighbor wouldn't pay more than $20 for a bond with a maturity value of $20. But if you were desperate for cash, you might be compelled to unload the bond for less than the $15 you originally paid. You've taken a loss, but at least you got some money out at the time you needed it. Investors buy bonds for two reasons. First, they're much safer investments than stocks, even though they have much less opportunity for a big profit. The interest is guaranteed as long as the company that issued the bond stays in business and has the money to pay its debts. This makes bonds a safe but not guaranteed investment. Second, bonds are used to offset losses on stocks when the economy is in a down cycle, because the value of bonds tends to go up when the value of stocks goes down. Okay. Here's a short version of why that makes sense. Okay, in our earlier hypothetical example where you're making a $5 profit for wanting to cash in your bond, if the economy is booming in the meantime, prices in general will tend to go up. So the $5 you're getting at some point in the future has less buying power than the $5 you were expecting when you made the investment. This makes the bond in effect worth less. The opposite is also true. If the economy fizzles after you buy that bond, the $5 you eventually get will in effect be worth more than the $5 you thought you were getting. So the bond is worth more. Stocks tend to rise when the economy is doing well and fall when it's not. So the value of bonds usually goes in the opposite direction of the stock market. So solve example 2 here says, suppose that you buy a bond with a face value of $1,000 that was originally issued 18 months ago. The maturity date is 4 years from the time it was issued, and the interest rate is 4% simple interest per year. If you pay $820 for the bond and keep it until the maturity date, what is your profit? We're buying the bond now. It was already issued 18 months ago. So it says, first we'll need to calculate the amount of interest the bond earns so that we can find your proceeds from the bond. We're told that interest is simple and is 4% per year, so we use our simple interest formula. So invested 1,000, right? 0.04 for the 4% times 4 years is $160 in interest. With a face value of 1,000 and 116 interest, the bond will be worth $1,160 at the maturity date. So the profit is $340. Okay. What percentage of your original investment is the profit that we found in solved example 2? So the profit is 340. And it's the percentage of what they paid. And so they only paid $820 for that bond. So pretty good investment. 0.415, so 41.5%. That's pretty amazing from what they paid and what they're getting back. So it says if you divide your total percent return from question 4 by the amount of time in years that you hold the bond, you'll get your percent return per year or annual return, which is a key indicator of how well an investment performs. So 41.5 divided by 4. So about 10.38% per year. A long-standing rule of thumb on long-term investments in the stock market is that you can expect annual returns in the 6 to 7% range. How much this bond and how would this bond investment compare? Much higher than the 6 or 7. We'll take it. So that's the end of the second video for lesson 3.5. Catch me back for page 339, and we're going to do some application work. So I'll see you back for video 3.